Okay, everybody, it's me, Gregory Mannarino. It is Sunday, May 15th, 2022. This is my newest segment of Markets to Look Ahead. Always lovely. I enjoy being here with you. It's a gorgeous day out here, and let's talk. Now, as always, before we look ahead, we got to look back. Let's take in this market as of late. It's been quite a rout for the since January. This market has been under pressure here. And I have said, and I have not wavered from this, to the displeasure of many, many people. I have said that this market is in some kind of a normal corrective phase. I still believe that is true here. And until, again, some major dynamics change. And nothing has changed. Really, honestly, we get a lot of talk here out of the Federal Reserve, what they want to do, what they're going to do. What they have done is raise the federal funds rate. We got a 25 basis point hike. We got a 50 basis point hike. And this market has gone kind of crazy here on speculation that the Fed's going to be, overly aggressive moving forward because of surging inflation. Now, if you follow this blog, you've heard me say this is laughable many, many times. The Fed has no intention whatsoever to do anything meaningful about inflation. They've gone out of their way, and I mean way out of their way, to create inflation, to overshoot their 2% target by exponents. Well, by their own numbers, or like at 8.5. Anyway, this is not by accident whatsoever. Skyrocketing debts, skyrocketing deficits. This is the norm now. This crisis to crisis to crisis, engineered crisis to crisis to crisis environment is the new norm as well. And every one of these gives the Federal Reserve and central banks around the world, I'm laughing. I hate laughing about this stuff, but it's true, a continued opportunity to inflate, and inflate on top of that. And they're not going to stop. That's the mechanism here. So I think you're all aware of that. Anyway, so just looking back on last week, and I covered this on Friday. Actually, before that, I started explaining on Wednesday how the market is, the S&P 500 is trying not to fall into bear market territory by definition. I know a lot of you have your own definition. I'm talking about what the textbooks say here. All right. And the S&P 500 is not in bear market territory. It is not 20% off of its recent all-time high. Yes, I will concede that the NASDAQ, I know you got to hear this, some of you, is in a technical bear market. And I have already explained this to you in my opinion here. It is a cyclical bear market with regard to the NASDAQ. A cyclical bear market. Should I tell you and make you do your own homework on this? Sometimes I debate these things. I'll tell you. It's a bear market that can last for months, as opposed to a secular bear market, which can last a very long time. I've also explained that the reason why we've seen such pressure on the NASDAQ is the tech sector is interest rate sensitive. And that's what's happening here. But I think the market's in an adjustment period. Okay, so looking back at the broader market, understanding what happened last week, we got a hell of a rally here off of support. I explained to you, I showed you a lovely chart, which I wish I hadn't thrown away, but I did, that the S&P 500 had some support at its recent level. It won't fall into a, look, here's the number. I'm saving this so I can show this to you. That's the number that the S&P 500 needs to fall below. You got it? This lovely number. To be an official bear market. We bounce off that. Now, I am not saying we're done. We're going to know this week if we're going to see this market fall further. If in fact we fall below that number, this week, the market's in more trouble, and probably a substantial amount of trouble. But gauging from what happened last week, on Friday here, this market making a substantial bounce. And I covered this Friday, if this market rallies tomorrow into Tuesday, that would be a sign to me that things are turning, okay? Now, I outlined for all of you in the ideal scenario, and I'm going to cover it again real quick for those of us that follow the market. We had a rally on Friday. If we get a follow-through rally tomorrow, and if by some lucky chance this continues on Tuesday, followed by a sell-off for which we cannot give it all back, that would be a clear sign, in my opinion, that the rout is over, okay? Believe me, the market understands that the Federal Reserve has no intention, really, to fight inflation, despite what's coming out of the mouth of our imbecile president and a lot of other people out here. You cannot believe a word that comes out of the mouth of that institution. See my hat? I'm going to point at the hat now because people think I'm pointing over here somewhere. Yeah, see the hat. Okay. This institution, public enemy number one. And they are going to continue to do exactly what they're doing to become the lenders and buyers of the last resort. Let me say this. Our forefathers who started this nation, this idea of a government of the people, by the people, and for the people, they literally must be rolling over in their graves seeing what is happening here. Had it not been for our forefathers who started this nation, we would today be living still under the rulership of a king and a queen, and living in some type of serfdom. Now look what's happening today. We are moving back to that two-tier society, where you have a ruling class, and this is absolutely not what our forefathers wanted, and we've allowed this. We allowed this to happen, and it's a horrible thing to see in my view. And people don't do a damn thing about it. They are just strung along by the mainstream media. Look here, don't look here. How this is sold to you, the current environment, which has been going on for a very long time. This slow burn into a ruling class economy again here, with the well-off and the rich becoming more well-off and more rich than ever in history, while everyone else gets squashed down to the bottom. It's not. This is not supposed to be like this, but we, the people, have allowed this to happen. And I can tell you that, again, I sincerely believe our forefathers would be so upset at us for what we've allowed to happen here. But again, we got to live with what we've created. And there's nobody out here besides you and me who really wants to do anything about it. Oh, sure, you got people protesting over Roe v. Wade, how this thing was just happened to be floated out here right now. And it's just an interesting thing to see and very sad at the same time. All right, look. So with that said, let's look around a little more here. What's going on in the debt market, which is the driver here of the market? Nothing. Zero. The debt market remained stable. We had one hell of a move down in the 10-year yield recently, from like 3.14 to like a 2.80. That's cash going into the perceived safety of debt. You know that. That's how it works. Cash goes into the debt market, 10-year yield drops. That's the polar opposite of what you would expect to see in a full-on meltdown situation. A meltdown situation will start in the debt market. I've repeated this a gazillion times. People don't seem to understand it. The stock market is a derivative, meaning it derives value from what is occurring in the debt market. When you see the 10-year yield drop like that, knee-jerk higher in the relative or comparative strength of the dollar. That's just fear, okay? It's not the big one. This is in no way, I know a lot of you are going to disagree with me because I don't understand why you can't see this. I can. You got a lot of YouTubers out here with big names who have been calling for a market crash every single month for years. They've been 100% wrong. They've not been right once. But they still have legions of followers who go, oh, it's this month. Oh, no. Oh, he was wrong. That's okay. Let's give him a pass. Month after month after month. I don't understand it. Yes, the big one is going to happen. But it's not going to begin in the stock market. It's going to start in the debt market. Once you can get your head around the fact that the debt market is the driver, you'll understand everything else. It is not what we're seeing in this market in no way, shape, or form is abnormal. If you understand the markets, if you've been in the market like me for a very, very long period of time, you've seen these kinds of things happen. All you have to do is look back on history and you can see where we are today. This is a normal route in an abnormal market. I don't know another way to put this, where the easy money is not going to stop. And the Fed and central banks are going to continue to inflate. All right, with that said, eyeballs back on the broader market here, S&P 500, trying to at least to attempt to stay out of bear market territory. I explained to you how this needs to play out. Tomorrow we need a rally. If we give back, let's just say this. If tomorrow we don't get a rally and this market sells off and gives back everything we just gained on Friday, well, then we know that there's more losses coming, period. The end. But that also does not mean that we're in a full-on collapse mode because it's the debt market that's the driver. All you got to do is look over at the 10-year yield. And you're going to understand, really, I don't even want you to look at the whole yield curve. Forget about the whole entire yield curve. I've tried to simplify this for you by having you look at just one thing, and that is the 10-year yield. Why? The 10-year yield is the benchmark. You understand? Okay, I think you get it. Crude oil, people, WTI over $110 a barrel, going much, much higher in my view. And I think I've covered this to the point of nauseum as of late, so we're not going to cover that again. The bottom line here is we need to understand what's happening here. We have to look at dynamics in the market, how they're playing out. We can look at the one driver of the market. We need to understand the end game of the central banks, and that is to continue to inflate, to become the buyers of last resort, to push the economy into crisis after crisis after crisis, and to prolong every single crisis and stretch these things out for as long as possible and call on the public to allow them to continue to inflate. Have a spokesperson like a mentally deranged president, for example, saying, oh, it's your patriotic duty to support these crisis, this crisis and that crisis, and we got to throw tens of billions and hundreds of billions, and we got to do this and that. You know, that's the mechanism here. It's all just a distraction. It's a lie, and unfortunately, people aren't doing anything about it. And just get used to that mechanism. It's going to continue as this nation free falls into yet again serfdom, into a slave society, which the whole world is now a slave society. You know, going back to our forefathers, they would be in full revolt right now. They would have ended this institution here. Okay, they didn't want a central bank to control the currency. That's why they had called for a gold standard. Once we allowed ourselves to be taken off of a gold standard and to establish this fiat debt-based economic model, it was over. It was just a matter of time before the entire world fell into slavery, debt slavery. We went from a wealth-based system to a debt-based system. It's an incredible thing. Our forefathers were so smart. They understood that by having a wealth-based system, it would also prevent wars. And that was also something that our forefathers didn't want to see. Understand, Wars can only be fought if we can continue to borrow cash into existence. If we had a gold standard or a commodity-backed system, we couldn't borrow endlessly into oblivion. We couldn't fight wars and continue to fund these things. I'll tell you, people, what we've allowed to happen is it's the worst thing that I can possibly imagine. We have a slave planet now, and we've all allowed this to happen. Sad thing. It's pathetic, and it's only going to get much, much, much worse here now that we know where we're going, leading to an absolute grand finale. We are leading towards a deliberately induced implosion of the debt market, and that's going to change the financial world. Look, all these guys who are calling for crash every single month, they're going to get it right at one point. I've never wavered from that. I've explained to people. In fact, I've been telling people a lot lately. The S&P 500, for which we are watching right now, it's gonna crater. I mean, we're talking about an 80% drop, in the S&P 500. I think that's reality, and it's going to be a wealth transfer effect on an incredible scale. Meltdown in the debt market is going to cause stocks to plummet like you have no idea, and extremely rapidly. Everyone's going to run for the door at the same time, not what we're seeing now. That's another reason why we know we're not in a crash, okay? Crashes are never slow burns. Everyone runs to the door at the same time. You get that panic selling, and people will look to take anything for whatever assets that they might be holding because they don't want to get stuck. You understand? It should be very evident to you, and I know the people out here selling fear. This is it. It's over. Run for the hills. A lot of these people are trying to, push their own agenda here. They want your views and they're selling it to you via fear. Me, I don't want you to be afraid of a damn thing. I've been telling you this for years. I want you to understand the current environment and look for opportunities here. With regard to gold and silver, we know the game. We know the game. I sincerely believe that we are going to see commodities, including gold and silver, balloon beyond people's wildest imaginations. Debt market implosion, cash bleeding out of there, putting pressure on stocks, cash bleeding out of there, just going to move like in a tsunami into commodities. And yes, I also believe cryptocurrencies as well. You all know my take on this, and you know how I feel about it. I don't want to cover it again here at length because this video is getting kind of freaking long. What else? I was just writing some stuff down this morning, drinking my coffee. Oh yeah, here's a couple of other interesting facts. So Tuesday, we're going to hear from the Federal Reserve, public enemy number one. And let's see what they say. Their narrative has been the consumer is strong. Economy is doing really well. We are, what are the words that they use? We're growing at a moderate pace, which is a complete lie, because out of their own mouth, our economy is shrinking, along with the global economy. But they're going to tell you we're growing. They're trying to convince you yet again that what they're even telling you is not real. I've been telling you for the longest time they're trying to convince you that what you see is not real. Now they just try to convince you that what they even tell you is not real. It's an insane thing. Also, we're going to hear from retailers this week. We got, let's see, Walmart, Home Depot, Target. There may be another one or two in here. And we'll see how that comes in as well. All right, look, you got a real good handle on what's happening here. We need to keep our eyes on that number with regard to the S&P 500. If we go below that, okay, that would be a bear market with regard to the S&P 500. I think the market's trying to get out of that. You understand the dynamics behind this here. We need a rally early in the week. It's beginning tomorrow. All right? Without that, we got to reevaluate here, and we should anticipate more losses at that time. But we'll talk about it when we get there, maybe even tomorrow. Anyway, look, so that's it, people. Look, very long video, important video. Please share it, get it out there. And I want to hear from you. Please comment on the things I've spoken about here, and I will read the comments. I will try to write back to some of you at least. And that's it. Have a great rest of your day, and I'll see you in the morning.